Hi, this is Brian Resney, President of Resney Wealth Management, bringing you an important update this week about the economy and the investment markets to hopefully better your portfolio for your retirement and better your risk management within that portfolio. We continue to get a lot of email calls on questions for our radio show, and of course our radio show has been just a huge success throughout Florida. I think the number one reason is objectivity and really giving that conflict-free advice to our listeners so they know that the information they are getting from us they can trust. We continue to get a lot of nice comments and requests for our fiduciary questionnaire. This is a generic questionnaire that we put together that allows investors basically to figure out if the person they are using is truly a money manager, a fee-only money manager, versus an advisor who is really just purely a broker or salesman of investment products or annuities or stocks or bonds or mutual funds. Folks, there's a big difference. And I thought I'd address that before I kind of talk a little bit about market commentary today. Again, if you have somebody that you're currently using, if they earn any form of commission, if they're through a broker-dealer, small broker-dealer or big broker-dealer, if on the bottom of their letterhead, on the bottom of the website to the company they work for, on the bottom of their business card, if there is a broker-dealer disclosure, like securities offered through, that means they earn some form of commission. There are rampant conflicts of interest in this business, in the commission side of the business, and I think investors really need to understand when you are working with a so-called advisor, financial consultant who earns any form of commission, or their firm represents products, your interests are put at the back of the line. Those people do not work for you. They work for the brokerage house or the insurance company. And unfortunately, when you're in a conflict environment like that, your best interests are not always going to be served. So just realize that, folks. Also, those people are not in a money manager capacity. They sell product. At the end of the day, it's up to you to put together that appropriate investment strategy, know when to buy and sell, and more importantly, have a risk reduction strategy within your portfolio. So if you think Mr. so-called advisor or financial consultant is really working for you, they are not. So just make sure you understand that. Use that fiduciary questionnaire. Ask those questions. No individual investor should work with anybody who is not fee only and who is not acting as a fiduciary under the fiduciary standard, meaning in your best interest. If you are, you're putting your own interest at the back of the line. Get objective help. Find a fee-only registered investment advisor who's not tied to a bank, brokerage house, or insurance company. You will be glad you did. Get rid of the conflicts, get rid of the excessive costs and fees built into these products by using a real money manager. Now about the general investment markets. As I made a comment on a radio show on Sunday, we've made some significant changes to our portfolio. We've added significant exposure to China within our portfolio. We continue to hold and added exposure to South Korea. We also added more exposure to small and mid cap within the U.S. Marketplace. I've talked about this for a number of years now, and I talked about coming out of recessions and why change needs to be made for you, the investor. What you owned, a year ago or 5 or 10 years ago may not be appropriate today. Important changes often need to occur within a portfolio as you are going through various market cycles. Now, one of the things that we've had a lot of comments or questions on are, again, about inflation. When do we think inflation and interest rates are really going to start to ramp up? We're already seeing signs of inflation. And I don't think we're going to see Jimmy Carter Day inflation, but we are going to see higher inflation, probably in the 4 to 6% range, which would add significantly to your cost structure as a consumer and also would weigh heavily on a U.S. economic recovery. I think outside in developing or emerging countries, I don't think this is going to be as much of a problem simply because those economies or majority of those countries and economies are fiscally sound. They run a decent budget. They're really watching their inflationary fears or demands, and they're taking advantage and really doing what they need to do before this becomes a problem for them. So I think on the emerging market side, because of their excessive GDP growth or the opportunity for higher GDP growth than the U.S., I continue to like the emerging markets. Again, we watch our positions every day. We're not afraid to make a change. I think the biggest thing that we look at, especially on the small and mid cap in the U.S., we feel that has inflationary opportunity. Small companies and mid companies have inflationary opportunity, meaning they can raise prices much easier than large cap companies. And again, large cap companies are 20-year ago news winners, and they're not today's opportunity. So again, if the majority of your portfolio is really sprinkled within that large cap counterpart, I know some of these pundits on Wall Street have been saying the large cap's coming back, it's going to come back, it hasn't rallied yet. Bottom line is this, folks. Wall Street people want to sell you Wall Street products. You want to do what's right for you. I've talked about this well over 2.5 years now, and if you would have taken my advice, I think you would have had excess returns and recovered your portfolio substantially faster than if you would have stayed with exactly what you had before. Small and mid-cap investments in the U.S. stock market continue to lead the rally. Emerging markets continue to do well, primarily China and South Korea. We're also currently looking at Brazil. We don't have any current positions really in gold or gold miners, only because we feel that they've been excessively pushed to the upside. We think there's a temporary bubble in these. We think we're going to have a pullback sometime in the next 2 months. And at that point, if we do get much lower prices, we will take a look at re-entering and adding some positions, possibly in gold and silver, and certainly in the gold miners or the mining companies for precious metals, which we believe is a better opportunity than pure gold play, whether it's an ETF or holding physical gold. If you have a question about your portfolio, if you're not happy about the advice you're currently receiving, call our office. We'd love to help you get your portfolio back on track without the conflicts of Wall Street, annuity salespeople, or bank representatives. Call us. We'd love to help you. Until Sunday's show, make sure you have yourself an extremely profitable day.